Greetings, members, one and all of the Salivation Nation. The Fed's mixed message to gold and silver. Let's explore. You know, gold and silver prices have really been volatile as of late. In fact, I made a video recently about how I am bullish on silver prices especially, but that's notwithstanding the volatility that we're going to see on its road in the positive direction. In fact, just after making that video, the prices went down fairly substantially, and we are looking at possibly some more uncertainty in the markets. And a lot of that is because of what the Federal Reserve says and what the Federal Reserve does. And right now they're sending some mixed messages that we're going to be talking about in this article from Kitco based off the events of the day. Gold prices pairs losses as Federal Reserve Chair Powell talks inflation uncertainty and stresses that it's premature to raise rates. And I've always been of the mind that it's going to be quite a while before that rate hike takes place, even though there's been talking about it. In fact, some people think, well, that's what's baked into the prices being lower these days. Gold paired some of its losses, rising from daily lows as Federal Reserve Chair Jerome Powell talked about inflation uncertainty, but stressed that it's premature to raise rates today. Inflation has come in higher than expected. Bottlenecks have been more persistent and are on track to persist well into next year. I don't think we are behind the curve. The policy is well positioned to address the range of plausible outcomes. It will be premature to raise rates today. You will want to see the labor market heal more, Powell said at a conference that followed the Fed's interest rate announcement. And we know that there's a lot of positions that are open that are not being filled by a lot of people who apparently are still at home and not getting the jobs. They're living on the government dole still, at least the states. You know, the Fed, I think they've stopped their payments in, but there's a lot of people that need to get back to work. The Fed chair admitted that high inflation is concerning. Well, that's the no-brainer of the century. Of course it is. And will likely last well into next year while still maintaining the word transitory. Imagine that. Well, yes. Well, I don't call well over a year of inflation being transitory. In fact, the longer it goes, the more likely it's going to be permanent. But he talks about that too in the following statements. Inflation in the medium term is our job. Well, I guess without understanding or knowing what the full quote is that we don't know what's in between those words term and is. There's 3 dots there. But assuming that they're taking this in context, yes, I would agree that it is their job. Their job is to print money that causes inflation. Now, we know there's other reasons for inflation as well, and I'm fully acknowledge that, but nonetheless, we know that the Federal Reserve is pretty much a big part of the contributing factor, the biggest probably, the second biggest being the supply chain issues. The level of inflation that we have right now is not consistent with price stability. Well, that's another no-brainer statement. Captain Obvious added again for Jerome Powell. For us, what transitory has meant is it won't leave behind permanent or persistently higher inflation. Well, I think that's out of the barn. That cat is out of the bag right now. So we acknowledge uncertainty around transitory. Sure thing. Yes, indeed. I think it'd have been better off not even using that word. Powell also noted that the word transitory has attracted a lot of attention and could be distracting from the Fed's overall message, which really means that they have poor messaging. It's not the only thing that's poor at the Federal Reserve, in my opinion. We try to focus on what we can control. Well, that's for sure. They want to control, yes, of course. They want to control the economy as best they can. The focus on this meeting is on tapering and not raising rates. So there's the mixed message again. So they're going to be tapering and not raising rates. There's still ground to cover to reach maximum employment, he described. Of course, the more money you print that the government doles out, well, that is going to be that means that you can control it. But then nonetheless, a lot of that also is Congress too. But nonetheless, our baseline expectation is that supply shortages and elevated inflation will persist well into next year. As bottlenecks resolve, inflation should move down by the second or third quarter of next year. Well, I think it's rather pompous to think that it's just going to go back to normal after that period of time. And by the way, we know these supply shortages and the supply chain problems, which are exacerbated by mandates, are certainly not just going to automatically just get better next year. But we'll see. Anytime you make a prediction and it goes out far enough along, well, anybody can say, well, hey, it seems plausible or reasonable that that would be the case because enough time has passed by, 3/4 of a year or a full year. Powell sounded sympathetic when addressing concerns over rising prices. Well, isn't that nice? Putting the blame on supply constraints. Of course, he's going to blame something else instead of himself and the Federal Reserve for all this money printing, which, by the way, they've been doing, especially with these repurchase agreements that they did in 2019, starting in September, well before the pandemic started. We understand the difficulties high inflation poses, but you understand that you create the problem with that. He says our tools cannot ease supply constraints, but they certainly can ease money printing. We continue to believe our economy adjusts to supply-demand imbalances and inflation adjusts to 2%, but the timing is highly uncertain. Yes, indeed. Well, that's because really the Federal Reserve is at a constant pace of printing money to the tune of, well, a target of 2%. The Fed chair is also not ruling out achieving full employment by the middle of next year, which could open the door to interest rate hikes. Well, you're not going to get full employment until people are forced to go back to work by essentially giving back all of the subsidies, essentially subsidies for not working. We live in a universal basic income style situation here. In fact, that's what a lot of this legislation is pointing to. And by the way, when I mention that, I'm not talking about everyone. Everybody has a unique circumstances, but the vast majority could be going back to work. These are jobs that are open. They're paying a lot more now, and there's no reason why they should be empty. These positions should be empty now. Earlier on Wednesday, the Fed announced that it would start to wind down its monthly asset purchases in November at a pace of $15 billion per month, citing substantial further progress made. Well, it's about time the tapering has started. The committee decided to begin in reducing the monthly pace of its net asset purchases by $10 billion for Treasury securities and $5 billion for agency mortgage-backed securities, the Fed statement said. Beginning later this month, the committee will increase its holdings of Treasury securities by at least $70 billion per month and of the agency mortgage-backed securities by at least $35 billion per month. Beginning in December, the committee will increase its holdings of Treasury securities by at least $60 billion per month and of agency-backed mortgage securities by at least $30 billion per month. The Fed added it is prepared to adjust the pace based off of changes in the economic outlook. The committee's assessments will take into account a wide range of information, including readings in public health and inflation pressures, the labor market, and everything else. Gold rose $15 from the daily lows in response to Powell's comments that showed that the Fed was not in a rush to raise rates at the time of the writing. And then it was down today, and it's down. In fact, we'll look at the prices right now. It's down $15 today. Silver is actually amazingly up a little bit, 2 cents, narrowing the gold to silver ratio to 75.32. So I think it's kind of a mixed message where gold and silver are reacting a lot differently. Although, noted, silver is still down and was dramatically down yesterday, but it has some resistance around the $23.50 level. Certainly at $23, it has some resistance. But we think that if we could see $25 silver, I think that could help potentially bring a new level of resistance, a new floor, as it were, and we'll see how that plays out. But there's where we sit. And supply and demand imbalances are certainly a concern to the pandemic, but we need to get to a point, especially after the election in the state of Virginia, the Commonwealth of Virginia, and where the campaign for Youngkin was that, hey, things are going to be open, schools are going to be open, we're going back to normal. It is time, folks. We need to get back to normal. We cannot run, we cannot hide from this virus. It's with us. The best thing we can do is to press on as best we can. Obviously, we've got to be careful and cautious. It's a real thing, but we have to continue with life. And there's ways to do it and still be careful and be cautious. That's a personal decision for each and every person out there, I believe, as far as vaccines and the like, or even masking or what have you. But I don't believe there should be any mandates of any sort anywhere for any reason at this point. This is a year and a half, almost 2 years into this pandemic. It's not going away. It's going to adjust. There's going to be different variants. And so therefore we have to get back to normal. So there you have it. And that's kind of where things sit with this situation. Gold and silver reacting. And we'll see how it plays out. Let me know what your thoughts are in the comment section below. We'd like to extend a multitude of gratitude to you all for taking the time to watch, and encourage you to please rate, share, comment, and subscribe.